And we are back with yet another cast of characters here on Overtime. I'm Ilya Spivak in San Francisco. That's Dylan Radigan in Milan. Mr. Mike Butler in Chicago. Gentlemen, thinking continues to be the wrong thing to do in these
Don't do it.
markets.
Don't do it.
It continues to be the opposite of what one is meant to be doing. Is that the only thing we're supposed to take away from all of this?
I mean, you're supposed to not think, and you're supposed to buy gold, and you're supposed to buy long-dated leaps if you're in any way socially associated with Mike Butler.
That's right. That's right. Yeah, this is a crazy market. But we've said before, like government shutdown tends to equal S&P, NASDAQ rally, weaker dollar over time. I guess the weaker dollar, the longer it lasts. But yeah, I mean, if no bad number can come out, why not just goose this thing up to 6,800?
Like we did today. Goose away, my friend, and take gold to 5,000 and take the Mag 7 10% higher across the board. And take the dollar higher while you're at it, Ilya. Why not have a strong dollar on the side?
I mean, a strong dollar on the side is really what's paying for my sins elsewhere here. Now, I suppose I can't be too mad at gold and silver. I was long them, and I did make money doing so, and that's all great. But I got out way too early out of gold, and I got spooked out of silver this week on that downtick at yesterday's risk-offy session, and that was definitely not the move, as it turns out. We're continuing to power higher here.
I mean, I guess my question for both of you is, how can you have any sort of ebullience, support, buoyancy, pick your favorite adjective, in the US dollar at the same time that the non-dollar assets, Bitcoin and gold, are spectacularly performing? In other words, I feel like gold is saying that the so-called debasement trade is on, and yet the dollar is stronger. And so I'm curious how you reconcile gold strength with dollar strength.
In my mind, the debasement trade is not on, and that's just the wrong explanation for what the precious metals are doing. Because when you look at what the dollar is doing, and then when you look at the bonds as well, the bonds are higher. So it's not like there's sovereign risk that's building in U.S. debt, or else we'd be looking at bonds that we're selling off. We'd be looking at yields that are going up for bad reasons, not for growthy reasons, but for, I don't want to lend to this borrower, give me more money to compensate me because they're crazy over there reasons. And so because you're not seeing the bonds sell off, because you're not seeing the dollar sell off, this whole debasement thing is, it's cute if you only look at the metals and stocks, I suppose, but it doesn't make any sense. Instead, I think what's going on here seems to be a kind of generalized defensiveness where nobody's...
You're saying risk off?
Sort of. I don't think anybody is prepared to sell stocks, but you're very clearly seeing that people are essentially allocating to things that they hope won't get sucked into some sort of mishigas. And the threat of mishigas seems to be rising. Since we don't have any data, we got a bunch of Fed speakers this week that really amount to everything that's on the calendar. I thought the remarks from one Stephen Mirren were particularly interesting yesterday, because not only did he not agree with the Fed consensus, he didn't agree with himself. And that was special. He came out and said, the economy was weak in the beginning of the year. Good thing it's doing better now, but that doesn't have implications for monetary policy. And you go, wait, so what is it that monetary policy does, sir, if not act as a counter-cyclical sort of force, keeping inflation from getting too hot and keeping employment from getting too weak? Apparently, he thinks that the fact that the markets cheered the rate cut means that more aggressive easing is necessary. And you go, you're saying the stock markets liked cheap liquidity. Who would have thought that? But it's an interesting sort of thing. The market sold off yesterday as all of this Fed speak was coming across, where Neil Kashkari, the Minneapolis Fed president, basically came out and gave the Fed consensus, saying, look, here's our risks, we're balancing the risks, as Powell might have said it. And then Mirren comes out and picks a fight with his own comments, picks a fight with everybody else, seems to be generally confused, and finishes it with saying, we must keep the Fed from political influence, though he technically is still employed by the White House while at the Fed. Strange things abound. Why not buy gold?
I mean, I would say why not short gold? But sorry, go ahead, Mike Butler.
I agree. Why not either or?
That was the wildest explanation, to just say, just buy gold.
Yeah. I mean, if the Fed is not going to make any sense, if they're not going to cohere around some semi baseline level of consensus, and if there's no data to tell us, yeah, forget these guys, here's what's really going on, then confusion reigns.
Yeah, I think when you look at
apparently including between Stephen Mirren and himself.
Well, what's interesting is you've got, to your point, Ilya, you've got you had or have some people speaking tonight.
Yes.
From the Fed, and then tomorrow morning, 7:30 Central, pre-market, you've got J-Pow opening remarks, jobless numbers at 7:30 as well. But when you look at
hypothetically
SPX,
speaking.
Oh yeah, sorry. Hypothetically speaking,
the BLS will publish something.
So it's funny that on the economic calendar that I'm looking at, there's a star, and when you read the star notation, data subject to delay if government shutdown continues, delayed in all caps.
Yeah. One thing that Stephen Mirren said that I thought was actually interesting, because he is, of course, very plugged into the White House chatter, one would think, since he technically still is employed there. You'd think he knows about this. He said that the U.S. economic data is still the gold standard, that the private sector alternatives to government data are not sufficient, and that he expects the Fed will have all of the data that it needs for October's policy announcement by the time that arrives, which is, if memory serves, the 29th of this month. So we are maybe getting some clues that the shutdown is near an end of some sort, or that at least the White House expects it to be short-lived. That's the generous thing. The less generous thing is Stephen Mirren just wants to cut rates until the end of time, and data doesn't matter. So, of course, we'll have all the data because the outcome in his mind is pre-foretold.
Yeah, pre-foretold.
Pre-foretold.
Pre-4.
Not foretold, but
no.
Not foretold. Pre-foretold.
Pre-4.
That's how certain he is that we need a gazillion rate cuts.
So the beautiful thing about prediction markets is you can search for anything. And right now, government shutdown ending, 14% have it between the 10th and the 14th. So sometime next week. And 82% have it at October 15th or later. So this market is projecting another week, 2 weeks-ish. What do you make of that?
Ooh, and then maybe we get CPI,
Yeah.
PPI, NFP all in one day and collectively lose our mind. That would be fun.
Could happen. But to that end, I think it's interesting when you look at, so you've got J-Pow speaking tomorrow. Maybe there's some volatility that comes out of that, but you look at SPX, 1 day expected move tomorrow, only 23 points. That's sad.
Yeah.
It's a sad amount of implied volatility. So I think the market is writing off his pre-foretelling of what is to be foretold.
Are you? I mean, I think there's a point where pre-foretelleration starts to become disrespect.
Yeah, true.
That's right. That's right. I mean, it's funny because when you look at the CME Fed Watch that distills what Fed funds futures are telling us about the market's consensus, it's actually a little bit less convinced, which is kind of funny. If you look in all of this at, in particular, the December policy meeting, the likelihood of a cut there now 77.6%. That's down from 89 a week ago and 82 yesterday. So interestingly, the market thinks that that third cut is less sure. In October, you're still looking at a 92% chance of a cut, but that's down from 95 yesterday and 99 a week ago. So there's an interesting thing that's happening here where the market is quietly going, yeah, maybe they, wait, are they not going to give us this third cut? What? Now, 77 is still high, in fairness.
Yeah.
In fact, anything well north of 60 is pretty much a lock. But nevertheless, it's going the wrong way. Mike, if you click on that compare button on the left, you can see how it's evolved over a day back, a week back, a month back.
I never used this tool. I just looked at the bottom. But yeah, this is nice.
Yeah, and then if you look at December, you can see it's ticked down meaningfully.
Yeah.
Over a week versus a week ago.
Yeah, I guess these ones are too far out. But yeah, this is a nice visualization for sure. But yeah, we're seeing both of these for the rest of the year tick down, higher probability. And I think we see this. We've seen this before with pre-Fed speak, where you just maybe they're pricing in more possibility, and then tomorrow morning, if nothing changes, you probably see these just rip right back up to 99%.
Very possible.
But you could also see it drop dramatically, the cut or no cut rise dramatically. Maybe that creates some volatility in the markets here.
Yeah.
I mean, what's missing from this discussion, in my opinion, with all due respect to both Mike Butler and you, Ilya, is a clear explanation as to what in the holy heck is going on with gold.
Yeah, I mean,
can we look at? I'm not trying to be a pain in your pain, but I'm telling you, look at this chart.
Yeah.
And tell me what's happening here, good sir. Because now, let me just understand, for the audience's sake, the reason I'm somewhat redundant and even aggravating on the topic, with the new rally in gold is now, as an enterprise, as a collective valuation, is the second largest warehouse of value in the world after the US dollar, ahead of the euro after today. I mean, something is going on, okay? Something is going on. And if it's not a referendum on the dollar, what is it?
I mean, China certainly continues to buy gold. Their FX reserves numbers came out this week for September. That's the 11th consecutive month that they've bought gold for their reserve. So that's a thing. But I think more interestingly, I think really what this gold rally is about is kind of strange happenings risk. And for me, sort of the avatar for strange happenings is or the ruling supposedly this month from the Supreme Court on whether the president gets to keep the majority of his tariffs that he's made contingent on IEEPA, which is the law that lets him do stuff in the event of a national emergency. And basically, that logic was struck down by a lower court, and now the Supreme Court has to weigh in on it. So I think what's interesting here is the market's spent the better part of 6 months now, from early April until now, benchmarking these tariffs and basically going, okay, that was the worst of the weirdness. Then the foam board and the whole nonsense. Then the president said, here's a 90-day pause. Nobody get yippee. I'm going to back up. And we've kind of slowed the roll there. We keep kicking the can downwind with China. So the market seems to be like, tariffs, whatever. Even the Fed is saying their inflationary impact has been less than anticipated. But if the whole thing gets tossed by the Supreme Court, you're back to square one. You have total uncertainty again. Because it's not like the administration is going to give up tariffs. But now, if they get tossed, then you have a clash on your hands. They're going to attempt to go at it again, somehow. And then the markets have to sit there and think, okay, well, maybe they'll use a different law, as they've done for some other tariffs, like aluminum and steel, for example. Maybe they'll do it that way. Maybe they'll do something else. But basically, everything that the markets have attempted to benchmark for 6 months goes out the window. And obviously, that's a lot of uncertainty. So maybe the market is just loading up on insurance.
Yeah, it's
Insurance on what exactly? If you don't mind my
random Michigan. I think the market is doing that thing that it does when wars happen. When a war happens, the risk becomes asymmetric. It becomes inconceivable, not quantifiable, weird, impossible to deal with the way that you might deal with financial risks. Like if you think XYZ number is going to be good or bad, you might take some sort of action. If you think that earnings might be good or bad, you might take some sort of action. War is the kind of thing that's non-linear. So the markets generally reflexively buy gold just on general holy moly grounds. I think we're getting to a place where maybe enough people are starting to buy gold and silver on just general holy moly grounds. What could happen tomorrow?
I mean, this is a historic move for many reasons, but I think what's most interesting with gold and silver is that, and it doesn't matter what you look at, gold futures, GLD, easier to look at GLD for long term, but implied volatility is still in the low 20s, the 19 handle. Like this is not even close to reflecting the reality of the move that we've had in GLD over the past couple of months. And yes, Ivy ranks at 56, 57. So it's on the upper end of the range. But to Ilya's point, like we usually see massive increases in implied volatility when you have these catastrophic down moves in the market where everything is red. But now you have this scenario where gold, GLD specifically, has gone from, let's call it 305 to 372. So just under 70 points in the last 2 months. When you look at where the next 70-point projected range is, it's all the way out here, June 2027, 600 days away. So in a 1/10 of the time, we have reached the upper bound of this implied volatility, and these markets are not changing at all. Like it's weird to me, to Dylan's point, it's weird to me that this thing is just going straight to the moon, but not even implied volatility is reacting in a way that would be seen as normal if it were any other product. Like if this was a stock doing this, you would see implied volatility in 100% through the roof. And you're just not seeing that at all, not even close to
or
being.
If this was a fiat referendum, you would see a weak dollar, blah, blah, blah.
Right. Yeah.
You're seeing a stronger dollar at the same time the gold is behaving like a maniac.
Yeah.
Well, so the last time that gold behaved like a maniac like this was early, if memory serves, was early 2023. Maybe 2024 into the beginning of the year. And what you saw there was just hand over fist buying out of China that was completely immune to any level of thinking about anything. Like we were looking at situations, in particular, sort of call it late 2022, early 2023, where their eyes was just relentless despite anything else that was going on. We saw similar dynamics going into, let's call it, the beginning of 2024, into almost the second half of the year, probably petered out, sort of on the way into this year a little. But all of that really was just non-economic motivated buying. So China not saying, oh, we're buying for this reason, for that reason, just buying, just growing reserves. And the theory out there has been that essentially what China wants to do is counter U.S. economic weapons as deployed against Russia, and say, okay, well, if ever the U.S. were to try to use these weapons on us, we need a payments structure that isn't dollar based, but nobody is going to trust a yuan based one because the yuan is locked on shore. It's not very liquid. There's, in fact, 3 different yuans, depending on which one you want to look at: the onshore, the Hong Kong-based offshore, the non-deliverable forwards. It's a mess. It's not a global reserve currency. So instead, why not say all the transactions on our payments system, sort of our SWIFT equivalent, our CHIPS equivalent, they're going to be backed by gold. Not the currency, the transactions. So that you know that whatever thing you might feel about doing business in yuan, the transaction is backed by gold. So worst case.
But how is that not dollar negative when anything you're talking about ultimately is some version of a non-existent conversation 5 or 10 years ago, because the dollar was the default mechanism of transaction, and now
they have been doing this for a while, and
but how is this not dollar negative? How is this
because you have to assume it's going to work for this to be dollar. So there is the intent, surely, for
marginal
this to be
debasement. Marginal debasement.
I mean, there's the sort of PRC argument, right? Which is, yes, of course, we mean to challenge the dollar.
A little side action, a little
right, but then there is, do the markets believe them? And if the markets don't believe them, because they shouldn't, because this is not going to work, it's nonsense. It's nonsense, right? So if the markets don't believe them, then all you're left with is just China buying a bunch of gold in prep for this. And
are you suggesting the gold chart is that China buying gold?
I think there's a number of things that the gold chart is, but I think that's part of it. We just got their reserve numbers. They just bought for the 11th consecutive month that they've increased their holdings. So they are buying, and they buy in size. So there is that. I think there is holy moly risk. I think there's that. So I don't think it's one thing, but I don't think
you don't think it's a debasement indicator.
Well, I mean, if the dollar was falling, then you could say, yes, the market believes that the dollar is being debased. But if you look at virtually any indication in liquid markets where that bet would show up, it isn't there.
Mike Butler, short gold, long dollar. What do you say?
Yeah, I mean,
no thanks.
I mean, I am long silver. So I'm long silver with a diagonal spread here. Small one. It was $300 for a 7-point wide. That's like a longer term one. But yeah, the tastyfx positions, we have been dabbling in a number of different things. I'm actually short a bunch of different pairs, but I threw these on today. The euro yen. So the yen's a huge mover today. Shorted the euro yen, shorted the British pound yen, and shorted the Aussie dollar, New Zealand dollar as well.
So you think there's a yen rebound coming?
I mean, I just think the move in the yen has been insane. We are now back to 2025 lows.
It's a bananas move.
Oh yeah.
I love it.
Yeah. So just with the FX products, it's nice because you can get super small in size. So I just look for these price extremes and just hold them until they reverse. And if they don't, I lose like $40. But if they do, you can make a similar amount. But it's nice because you can just hold them perpetually. Some of them you get paid based on the swap. But yeah, this move in the yen has been quite the move.
Yeah, I mean, you wonder where it runs out of steam, because this is not happening for sort of data reasons or sort of small reasons. It would be wise to think, and I think back to what was happening when you initially got sort of the ascendancy of Shinzo Abe, the mentor for what's about to be the next prime minister of Japan. Her elevation is really what's doing this. Her mentor, Shinzo Abe, who was assassinated several years back, he famously sort of had a hand-picked BOJ governor in Haruhiko Kuroda, and the plan was flood the market with liquidity, ease. And she is of this mind. She thinks this whole thing with what the BOJ has been doing, raising rates under this very non-conventionally Japanese new governor, Kazuo Ueda, that this is all wrong, essentially. And when Shinzo Abe first was about to become prime minister, and it became clear that he was, and it became clear that he was going to put Kuroda to work, easing until the end of time, the yen ran and it never looked back. It got crushed, just absolutely demolished for months. Back to back to back to back. Once this thing goes like this, sometimes it just keeps going because it's a political shift. It's not the reaction to a piece of data. This will be now policy in Japan for who knows how long. And so this thing might have legs, and it might have legs for a while yet. Not in a straight line, of course, but we could be looking at yen weakness for a very long time.
Someone in the YouTube chat asking, wonder if the weaker yen is propping up the dollar today, or at least over the last couple of days.
Certainly helps. Certainly helps. But the dollar hasn't set a new low since July. So yeah, there is that. In fact, if you look at where that last downtick is, where we last tested the July low, there you go. That's the Fed. That's the Fed meeting.
That's last rate cuts, not as soon as you hope.
Yeah, that just tells you how not dovish the market saw it. That was the turn in the bonds. That was the turn in the dollar. If you look at where the pullback in bonds is, same spot, 17th, 18th of September.
Yeah.
That's the markets going, yeah, they were not dovish enough.
That was a pretty funny day because I saw that everything was red. We were down like 50. And I was like, oh, okay, we're back to normal. Went into a meeting, came out of the meeting, everything was green, ripping up higher. I'm like, oh.
Less than an hour.
Just in case, yeah.
Less than an hour. And by the way, the moves in the bonds stuck. Obviously, here we are. The move in the dollar stuck. Obviously, here we are. The move in stocks didn't even have 60 minutes in it.
No. That was this day. Here we go. Look at that. Just liquidity blast.
I never get tired of both looking at stuff like this and going, well, these are like, read any book about bubbles. This is what happens. Like, sense goes out the window and things go up for no reason. But also, all of those books will tell you, yeah, that this is exactly what happens, and you can never know when it's over.
Speaking of bubbly moves, AMD, your time to shine, baby. AI deal, stock just ripped from 170 up to 230. Tried to sell off today. They said no. How about we don't do that? Nvidia, likely a sympathy move with that. The chippies are
Funny,
chippies are back.
I was sniffing around AMD and Rivian as well for sort of sympathy moves to things we've seen in other things. Rivian hasn't found a bottom yet, but man, that AMD move certainly. It certainly challenges me to be more open-minded and more ticker agnostic, because I look at AMD and go, but I don't want to buy no stocks, and then maybe I do.
Yeah, maybe you should have.
And it sort of backs up my Amazon argument, which is just look for the sleeper in the room.
Yeah,
because it's only a matter of time.
Yeah, especially, I think that's very true for established names like Amazon or established sectors where there's going to be demand, like in anything AI or chip related. If you find a product like even TSM, when Nvidia was hitting all-time highs, TSM was near lows of the session. Same with AMD. So yeah, there's always going to be opportunities. I think when it comes to Tesla, the sleeper in the room to the upside, crazy ranges the last couple of days, but to your point with Rivian, I was looking at Tesla and I was like, okay, what is Rivian doing? And I saw it was down. And then I was like, oh, you know what? Let's check out Ford. Let's check out these fringe EV competitors that are not even scratching the surface. Down big. GM, down big. So I think this is a really strong nod to Tesla in what they're trying to do to take over this whole scene, because when you have all three of those products moving in the opposite direction, I think it just speaks to the strength of Tesla's rip to the upside.
Yeah. I mean, it's one of those things where, I mean, as we've been talking about, thinking is not your friend. The problem is that finding out where you have to be thinking is either going to be done by getting kicked in the side of the head, and the idea would be that you've accumulated so many gains by that point that you sort of take the last thing on the chin and go, okay, well, net, I'm way up, on we go, or you have to be somehow anticipating something. But it's very difficult to want to be betting against any of this when you're not getting paid for it whatsoever.
Yeah. I think when it comes to fading moves, I like to look at products that have low implied volatility. So like, I think if you're trying to fade silver or gold, you can get into a trade like that and it does not cost you a lot if you are wrong. But in a product like Tesla, $500, high implied volatility, like these options are super expensive. These spreads are going to be super expensive. I think really the only way to do it is with a credit spread far out of the money, but those are not as, those don't come in as quickly as a low IV product moving in the opposite direction might, like gold or silver. But who's fading those things? Impossible. The only thing I'm fading here is crude oil. I kind of liked what it did today. It sort of stalled against its former support, become resistance. So it broke down, corrected, and then stopped right on that inflection point mid-range where it had a bottom before that it cut through last week. So I've used this bounce to get a little bit short. We'll see if it goes, but at least the price action looks encouraging. Yeah, I've been trading crude with the micro contract. So I've just been, and it's a $6,000 product if you use the micro. Same thing here, but I've been getting long around 60, 61. So I caught this rally here. I closed it for like $100 winner. But yeah, I'm in the same boat. I mean, crude oil has been and will continue to be a great trading vehicle because it still gives us two-sided action. Like it's hard to find, especially these days, it's hard to find products that move swiftly in both directions, where if you're short here, you're going to find a place to be profitable down here. If you get long here, you find a place to be like, this can be a two-sided market where both parties can be profitable as long as trade size is in check and you can hold through these periods of volatility.
Yeah. Yeah. It's an interesting thing, Crude, because you'd think there is some element here of a cyclical something. We'll see if that lasts. I think the point Dylan has made, which I agree with, is that either it's got to be geopolitics or it's got to be something about sort of real global demand. I think concerns about an oil glut are getting significant here, but you don't get an oil glut unless global demand is falling away. And so it's interesting if it goes. If it goes, then the global economy is weaker, and then we're going to get all of these rate cuts that the markets want, but for the wrong reasons. Although markets don't seem to care what the reasons are at this point.
I mean, the question is, why does oil trade the way that it does?
Mm-hmm.
And obviously, there's whatever the supply-demand discussion is, which is never ending. Obviously, there is sort of global macroeconomic activity, which I would argue the tariffs are oil negative, right? It's sort of marginally less shipping of things.
Yes.
But ultimately, I still believe that the number one driver of oil pricing is perceived disruption in critical portals of oil distribution by virtue of war or the threat thereof. And so I just feel like oil kind of drifts around in this sort of macro-ish world, but super unpredictable, in my opinion.
I agree.
But for super spikes triggered by extreme geopolitical situations.
Well, here's a counter narrative. Here's a counter narrative sort of in that space for you, right? So obviously, you and I both were very avid sellers of crude oil when it would spike on
the super spot, the geoprice spike.
Right. So like Israel and Iran would start squeezing off missiles at each other, and you go, yeah, okay, neither one of these two want a real, neither one of these two want a real fight. Fade this. Would you be of the same mind if it went the other way, in the sense that you seem to be in some kind of a turning point in this Israel-Gaza theater? Where
still on the in the wings.
Maybe. So the Trump administration unveiled this deal. Everybody seems to like it. The Israelis have signed up. All the Arab states have signed up. A ton of the majority Muslim states like Indonesia and Malaysia and Turkey that are not Arab states but that are Muslim majority states by a mile, they've all signed up. Everybody thinks this is good. Hamas seems to be in the final stages of kind of accepting a version of it. They're in Egypt now, ostensibly figuring out the details. What happens if crude oil spikes down because some kind of an accord is reached? Do we buy that deviation because global demand is still what it is?
I like the question. Or do you buy it because you believe that basically some level of interstate or international tension is the base state, and that even a peace deal is as short-lived as a hot war deal?
Right, and that Hamas ultimately is just not an organization whose very existence is amenable to peace. They're just that's not who they are. So maybe they'll spike the whole thing.
Listen, I think it's got to get the sort of price extreme that you see with the spikes higher. But I don't mind the idea of buying oil on the peace dip. Even though I obviously personally love the little piece, but
that would be wonderful, yes.
But from a trading perspective,
yeah, I mean, I'm sort of starting to think like, okay, if you get a peace deal, it probably spikes down. And then eventually you kind of have to get back to
Comes back to
global
the middle
demand
if
is at a
nothing else.
level.
Yeah.
Russia, Ukraine still are very much an annoyance in this space. So do you just recoil then?
Or basically to sort of at least sell a put spread on the dip on a bet that
Yeah.
it comes back to some mixy little middling something.
Yeah, maybe at least vol comes out of it.
Right. Mike Butler, what say you?
Yeah, I like it. I think if you want to go the option route, the CL main contract is super liquid. You can do pretty much anything you want. But yeah, if you're selling a put spread, you're going to get a bigger credit or move it out of the money further when you're doing it on a down move. So if you're trying to get into this trade, maybe set an alert or look for a period of time where the market is down. But yeah, I mean, you can set really low boundaries here. If you're going out further than the 8-day contract, this X contract that we're looking at expires in about 10 days ish. So the next one is actually a lower price point. The Z contract's at 61.81. So if we look at that one, we will see a similar but different chart. But yeah, you could sell a put spread below 60, and that would get you to a range that we haven't seen since early June. And that looks like if you do like the 26-day or even the 40-day, both of those go to the Z contract. But 26-day, if you just sell the 60 strike, for example, you can pick up $300, risk 700, and just play that game. Or you can go a little further out in time, go to the 40-day, do a similar exercise, get a little bit more premium. But yeah, I like the idea. I've been trading these straight up with the micro contract. So anytime I see a big dip, like into this sell-off, I bought it at like 61. So I took a tiny bit of heat, but got the reversal, fortunately. But yeah, I like the micro static one because then you can get, so the spreads we were looking at, your max profit's $300, but you got to hold it for a month. Here, you could get $300 in 3 days if you just time it right and you are sized correctly to where you can hold it. So I like the micro static delta a lot with these things.
USO also a good vehicle for this. It's relatively easy to get filled, and you can keep your position size a little bit smaller. That's the way I'm doing it for this one, mostly because you can get options in MCL, but if you wanted to go even smaller and just keep things very liquid, because MCL is not as liquid as USO. So if you wanted to get filled, have a kind of smooth experience, and keep size small, USO is pretty easy to move around in.
Yeah, $70 price point. This one and the natural gas fund, they are subject to oil futures if there's big contango or backwardation, which there really isn't, interestingly enough, in oil right now. All of these contracts are around 61, so it won't feel as drag and drifty as if we were to get a bigger divergence here. So yeah, I think USO is totally viable.
What is the ticker on that natural gas fund? Is that CPR?
UNG.
UNG.
Yeah. Same concept. But if you look at these longer term, what you tend to see is something like this, where because of the steep contango, they have to continuously rebalance this. These are probably periods of backwardation where you get this huge rip up, similar to USO. But as you can see, this was the massive sell-off in 2020. Since then, we've kind of lifted from there. But this is due to the fact that, when you have a lack of steep contango, you can have this price float because you don't have to pay to continuously rebalance, and you lose buying power every time you rebalance in a contango state. So yeah, love it. A couple minutes left here. Any other sectors, products standing out to you two?
I think if you're going to do anything in the in the currency space, because I still think the biggest kind of idea that's on the board here is a stronger dollar. That's sort of a thing that's both working and still cheap. And so if you're going to look at anything in that space, very interesting setup now in the euro, in the pound. Both of them are sort of at their near-term range barriers. And if you take this out here, so let's say if you take out 115.80 on euro, if you take out 133.25.30 on pound, those moves have legs then thereafter. I'm also looking a little bit at Bitcoin and noticing that it had a really nasty sell-off yesterday. It had a bounce today, but the bounce today was not what you saw in stocks. I mean, obviously Bitcoin is up on a risk-on day, no big shock there, but it looks kind of soggy relative to what the NASDAQ looks like, what the S&P looks like, which obviously I nibbled on the short side yesterday, and then when it ripped today said, oh goody, let me keep my losses small. Goodbye. But this is interesting now. If you're looking at the continuous Bitcoin contract also, you'll see that this is something of an auspicious level. We've been near these highs before. This is a breakout through the high from August that's failed, where we've come back in after that breakout. We couldn't hold it. So, and the price action on this risk on day is soggier. It seems to have been more responsive to bad news than good. Kind of starting to think that maybe tomorrow, if this continues and this continues to be a kind of weak need, then there's an IBIT put vertical in my future.
Yeah, IBIT's an incredible.
I like IBIT. I like IBIT. You can get such amazing risk reward. I love it.
Yeah, I mean, $70 price point, penny wide markets. Like, this thing trades more than SPY on a day-to-day basis, which is crazy
incredible
to say. Not today, but
no.
If you check this in the morning, IBIT actually did trade more than the Qs today, which is crazy to me. But if you check this in the morning, like, IBIT almost always has way more share volume than SPY and Qs combined until the day kind of drags on. But yeah, it's here to stay. And like we're saying, you can get into this from an options perspective, penny wide markets, super liquid. If you're bearish, bullish, doesn't matter. You can get into diagonal spreads, calendar spreads, short premium trades. And yeah, the world is.
You can actually trade Bitcoin as a normal asset and not as some many $1,000 hodl nightmare.
Well, hodling hasn't been a nightmare in Bitcoin. You buy it, forget about it.
Not if you're a hodler, no. But if you're a trader and you want to be in and out, and you're thinking in 45 DTE terms, it's a nightmare. It's incredibly expensive. It's not a two-way market because everything is so huge. The margins on everything are so massive. If you're looking at BTC futures, rightly so, IBIT solves all those issues. It's cheap, liquid. There's options.
Yep.
Godspeed. Enjoy.
It is quite lovely.
And you can do what I like to do, which is bet against it.
Your final thought, just bet against everything, unless it's gold. Can't do that.
Can't bet against gold, can't bet against silver, can't bet against the dollar, can't bet against the bond. Can't do it.
So tomorrow, SPX implied volatility, 21 points, disgusting. Do you think we are inside that level, or do you think JPOW sparks a little something in this market and we go outside up, outside down? Where do you have us tomorrow?
I don't think Powell says anything. He's giving intro remarks at a community banking conference.
There you
I
go.
don't think it's, I don't think it's the hot heat that he's got for us. Could be, but you never know. Man's obviously in a mood recent months, but rightfully so. But I doubt he says anything. I'm more so curious about what the market's default to doing after. Like, they get through his speech, he says nothing, and they go, right, so what's the path of least resistance now? And who knows? There's no data. I mean, University of Michigan consumer confidence on Friday, that could be something. That's got inflation expectations in it. But without data, it's just whatever the default turns out to be. And as we've learned, the Dylanism of Dylanisms, the default is don't think.
Yeah.
I think it is interesting, though, when you think of the default being up and to the right, but when this data comes back, if any of it is hot or bad, then you could see some real volatility because, like,
Yes.
Let's say we erase 2 weeks of movement. Well, the last 2 weeks has been straight up. That's 200 points almost to the upside. If you erase that in one day, now all of a sudden we're talking. We might see an actual VIX spike that means something.
I believe alcoholics refer to this as a moment of clarity.
There you go.
When the shoe fits.
When the shoe fits, and boy, do they fit.
And with that, we are out of time for overtime. Thank you, gentlemen. We'll be back tomorrow at this precise time for more conversation on all of these things. But don't go anywhere. I'll be back in mere seconds here to look at the FOMC minutes that came out today in exhaustive detail and what all is happening on the macro front. Macro money's coming up, so sit right there. We'll be right back.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
New from Tasty Trade. Unlock 30 days commission-free trading, plus a 1% cash match on all qualifying deposits when you open and fund a new Tasty Trade account. The Money Match event starts now, exclusive to new Tasty Trade customers.
Frequent trips to Vegas, or there was a year I did a couple of them.
What's the most financially irresponsible thing you've ever done in your life? Doesn't necessarily have to be trading specific.
Financially irresponsible, that's a big question. Like, people would say, like, going to college these days. I don't know. renting. I like renting. I like the flexibility. I don't know, maybe renting, I guess, by the book is financially irresponsible. Actually, you know what my biggest purchase right when I started my job was $4,000 on a PC setup, which was not a good idea at my salary point.
I mean, anytime you take a trip to Vegas, it's pretty financially irresponsible. I would say that frequent trips to Vegas, or there was a year I did a couple of them, which was pretty irresponsible.
When the market moves, traders need to move faster. tastytrade Active Trader Tool offers full depth of market visibility, one-click order entry, and instant position management so traders can react in real time. While others charge for professional tools, tastytrade provides them for free. Opportunity can move fast. Seize it with Active Trader. Try it now on tastytrade.
When you define risk, you set a limit on how much you could lose if the trade goes bad. If you have a small account, you might not be so interested in selling naked options. You'd use up much more buying power, and the risk is undefined. Defining risk, though, controls how much you can lose if the trade goes sour, and it gives you back some of that sweet, sweet buying power. We can define risk by combining options into certain strategies. The short put vertical spread is the simplest one. Selling this put sets your max profit with the credit, and the long put at the lower strike blocks off the risk where you want it. And if you're more neutral than this, you can throw on a vertical call spread to make it an iron condor. The only downside to defining a risk is that it lowers both your max profit and your probability of profit. That little compromise might mean you rest easier, though, and a good night's sleep is priceless. So see, we can define risk when we use more than one option at a time. Pretty simple. Got friends? Get $250. We'll give you a bonus for each qualified person you refer to tastytrade. So spread the word and earn rewards. Terms and conditions apply.
And we are back to looking at a stock market that is powering higher. Minutes from the Fed policy meeting from September, seemingly not enough to move things one way or another. They barely register at all. We're going to break down what's going on and what we might expect from here. I'm Ilya Spivak, head of Global Macro here at tastylive. And this is Macro Money. What we're going to do here first is take a look at what the price action ended up being for today and how it ended up shaping the narrative that we've been following here. And then from there, take a look at what is likely to be next for these markets. Of course, it is a tricky environment here because being a macro sort of trader here is very difficult. There's no macro data. The government shutdown has basically derailed all of what we'd be looking at, or almost all of what we'd be looking at, to get our bearings. But nevertheless, price action continues to tick, and so we continue to look at it. So here is what we are seeing for today. Stocks have a potent rise. Whatever sogginess there was yesterday shrugged off with gusto. The S&P 500 up 0.6%. NASDAQ up 1.25%. What's interesting is that yields ultimately don't go anywhere. Crude oil continues to recover a bit, but still inside of the decline that we saw last week. Of course, we saw crude had a sharp 7.4% sell-off last week. We're still attempting to claw our way back and only about halfway there. Gold continues to power higher. Absolutely breaking through any and all semblance of a barrier, up almost 1.5, 1.47%. And so as we look at this now going forward, we find there's really not a distinct reason one can point to for this gold rally other than sort of generalized desire for some sort of store of value that isn't the traditional, that isn't cash. But it is very difficult to come to the conclusion, as some in the markets have, that what this is some sort of a debasement of the US dollar. I mean, that's very plainly wrong, because what you see, among other things here, is that gold and the dollar are going up together. And while bonds don't have a big move here today, and in fact, at the 2-year maturity, they come back in a touch, bonds are not falling. In fact, the up move in bonds remains. So this sort of idea that there's some kind of a sovereign risk in U.S. assets is not based in reality, as it were. Since the Fed meeting last month, bonds are, on the whole, still up and moving higher, though we had a little bit of a pullback because the Fed turned out to be less dovish than the markets thought, so yields ticked up a tad. But the trend in bonds that has been durably pointing higher now, all the way back to late May, it is very much intact. Moreover, just in terms of near-term price action, we can see here, sure, gold is up a lot, but also the dollar hasn't had a lower low since July, and even just over the past day here, euro off by 0.25%, the yen continues to sell off, down almost 0.6%. So this move in precious metals is not a dollar debasement move, else the dollar would be down, and it is not. It's not a U.S. sovereign risk move, which would be sort of the parallel to dollar debasement of some kind. Bonds are not crashing. So something else seems to be going on here. There's all kinds of theory making one could have. Certainly an 11th consecutive month of China buying gold in size for their reserve account. That's a part of this, surely. Not the whole thing, but at least to some extent. The possibility that the Supreme Court might overturn the Trump administration's flagship tariff batch. Not all of the tariffs that the administration has pursued are contingent on national emergency grounds via IEPA, but most of them are. And a lower court has said that the president can't make that argument, that there isn't a national emergency, that all of these tariffs can be reasonably tied to, and so he doesn't have the authority to levy these tariffs. It's going to the Supreme Court. We're looking for a ruling perhaps sometime this month. Maybe gold is up just on general defensive grounds because we have now 6 months that the markets have benchmarked a key pillar of economic reality as we find it today. And if this Supreme Court decision goes the other way, then we're back to square one. We're essentially back to early April as far as trying to figure out what tariffs we have or don't have and what all of it means. Because I don't think it's reasonable to conclude that if the administration is ruled against, then what they'll do is go, oh, well, I guess we didn't get it. Maybe next time. Pack up and go home. No. Almost certainly, if the IEPA logic is overturned, the administration will try to deliver these tariffs by some other way, contingent on some other powers, or figure out some sort of other way to get this done. So that opens up a whole basket of uncertainty around what fiscal policy is going to look like. So maybe that's what this is about to some extent as well, and sort of adjacent type of things. We still are waiting for the hearing on Lisa Cook. She gets to stay as Fed governor, but we'll hear in January, once oral arguments are done, if that is going to continue to be the case. So maybe what we're seeing in the precious metals is just generalized hedging against non-linear event risk. But for what it's worth, dollar debasement doesn't seem to be what this is. So, with that in mind, we move on to what we heard from policymakers today. As ever, in the absence of data, we are in Fed watch mode. We had another big batch of speeches today. Nothing of substance from Musalem or Barr today. And of course, we heard from Kashkari yesterday. He's in a kind of Fed consensus state where he's saying, look, we don't know what the impact of the tariffs is going to be on inflation yet. We need to be cautious. We need to take it one step at a time. If we do too much easing, we're going to let inflation out of the bag again. We don't want to do that. So that's the majority of the Fed, and we know this consensus already. The interesting bit on the calendar today were these FOMC minutes from September. And here are some highlights from those. Almost all participants supported the cut. Shock of shocks, one wanted a bigger cut. There's no way to know, of course, that this was Stephen Miran, the Trump administration's appointee on the board most recently, who paradoxically still nominally holds a job at the White House as the chair of the Council of Economic Advisors, though apparently he's on leave from that role while he serves out until the end of the year the term that was vacated by Governor Adriana Kugler. But clearly, when we look at the dot plot here, everybody is here. One person is here. And we heard from Governor Miran yesterday. He clearly doesn't seem to see any sort of conflict or tension between, on the one hand, asserting that the economy is warming back up, having been weaker in the first half of the year, which is incidentally encouraged by at least some economic data, not all of it, but at least some. And at the same time saying, well, this doesn't have any implications for monetary policy, this strengthening. We still need aggressive easing. Just look at how much the markets love aggressive easing. Surely that means this is the correct policy, which is high comedy because, of course, when have the markets ever not loved cheap money? So it's interesting to sort of tie things up that way and say, well, this is indicative of anything at all other than financial markets like cheap liquidity. So, of course, but in any case, we clearly have the sense here that there is the Fed consensus and there is now this sort of lone voice in the wilderness, which falls closer to what the administration might have said. Most participants judged that downside risks to employment have increased and upside risks to inflation have either diminished or not increased. That's how we ended up with that cut. We knew, of course, as much looking at the policy statement itself, which asserted essentially this. Most participants judged that it's likely to be appropriate to ease policy further. We know that also. We can see here we've actually somewhat retrenched on rate cut expectations. The probability of a cut has come down for the October meeting to 92%, whereas we were at 99% a week ago, but it is nevertheless commanding. So we are very much on course for a cut when the Fed meets this month. For December, we're back down to 70 odd percent, about 77, down from well north of 80, and closer to 90. But again, still very much a convincing rate cut story here. In fact, as long as you're, I would argue, durably above 60, it's kind of a given that you're going to get this cut. So most Fed officials think another cut is coming. The markets generally agree. Almost all participants noted that with the reduction in the target range, so this rate cut, the Fed is well positioned to respond to whatever comes next. So if inflation ends up looking like it's more assertive than the Fed judged, if we get a weaker economy than the Fed expected, all of those things apparently in scope here, the Fed feels like they're not behind the curve, they're not in a hurry, they can essentially move as they've been moving and find themselves sort of in a relatively comfortable space. The interesting thing comes here where a majority of participants emphasized upside risks to inflation. We know which one, of course, thought that this was not a big deal. In fact, we heard from Governor Miran yesterday, who said that he's just not as concerned about inflation as other policymakers are, and doesn't think the tariffs are going to be a big deal there. But a majority is pointing to inflation readings moving further away from 2% and saying, well, what if this is sticky? What if the effects of the tariffs are greater than we thought? And what if inflation expectations end up getting anchored even if the tariff near-term impact fades? So most are concerned that inflation might run away. Most expected that inflation's effects vis-a-vis the tariffs will be known by the end of next year. So the market's still expecting, and the Fed officials endorsing this idea that it's going to be a one-off for inflation costs, not something stuck in expectations. We'll see to what extent that holds up. Some participants noted that by several measures, financial conditions suggested that monetary policy is not particularly restrictive. What a shocker. Stock markets are at record highs. Gold is at a record high. Silver is surging. What could possibly have told policy officials that maybe, just maybe, financial conditions are not restrictive? I am shocked and appalled. Several participants noted that financial conditions were supportive of economic activity. Well, so it seems, if they are not restrictive or not that restrictive, as it were. Indeed, we continue to see that the flow of U.S. economic data seems to be turning out on the whole better than expected. Obviously, we got some very soggy ISM data last week, and the official data that we usually look at is on hiatus while we figure out this government shutdown. But since July, data has tended to outperform relative to expectations. It's been this City Surprise Index has been sitting above zero and moving cautiously from the lower left to the upper right. We likewise see, looking at this GDP Now model from the Atlanta Fed, never mind what it actually says about third quarter GDP, it's not a meaningful estimate yet, still much more data to go in here, but the direction of the green line here tells us that the tone of the data going into this model every day, every other day, less so since the shutdown, that all of this has generally shaken out to be GDP positive, hence the model rising. So never mind the outcome, but the tone of the data seems to have been relatively positive. Now, what's interesting in this context, of course, is that we still have only one rate cut from the Fed on the menu for next year. and only one rate cut thereafter, we barely squeaked out 3 for this year, and that's because this weird dot basically shifted the average and narrowly bumped it that way. But the markets are still of a much more dovish disposition. They see 62 basis points next year. They see at least 36 basis points this year, and of course we've seen the probabilities now for both October and December, and the markets are erring on the side of there being cuts there. So we're in a situation seemingly where the market still thinks the Fed is wrong and not dovish enough, in particular for next year. There's still a big disconnect there. But of course, until we get some kind of economic data, there is no forcing function really to get a reckoning to happen. There is perhaps a little bit still on the calendar for Fed speak. Most importantly, tomorrow, we're going to get a speech from Fed Chair Powell. If we look at what's actually on the menu for these speeches, though, we can see what Powell is doing tomorrow is just giving the welcoming remarks at the Community Bank Conference in D.C. It's not anything that is immediately sort of evocative of market-moving information. It's not an economic outlook. We are going to get an economic outlook from Governor Michael Barr. We'll see what that entails. That could be something in the absence of other news, but we still have a seemingly glaring disconnect here between what the markets are thinking and what the Fed is thinking. On one hand, this kind of chart tells us that the Fed is right to be reluctant, and indeed, if we look at this relationship between the ISM service sector index for prices, which tends to have about a 2-month lead on official CPI and PCE numbers. We're supposed to get CPI, we didn't get it. But we can see here that the dynamics seem to suggest that we're due for some sort of inflationary run-up. It's unclear whether the Fed is going to care, because they seem to be saying that the impacts from the tariffs, such as they are, is something that's going to work itself out. Powell told us by the end of this year. Most officials think surely by the end of next, as we just learned in the FOMC minutes. So it's unclear whether the Fed would actually take the realization of this inflation that's getting telegraphed here as anything to suggest they should be shying away from more stimulus. But they certainly may not go at it as hard as the markets want them to. At least for now, though, this disconnect continues to linger without the markets feeling like it needs to be reconciled. For what it's worth, we have a relatively sanguine view in the markets about inflation, and we can see that inflation expectations, as they're tracked here by the break-even rates, 5-year and 10-year, they haven't really gone anywhere. So while the S&P 500 has gone higher, inflation expectations haven't rebounded from April's lows. We can see that what the markets were worried about at the start of the year clearly was a growth kind of concern, where stocks fell and inflation expectations fell, telling us that the markets were worried about some sort of a recession-like scenario. Since sentiment started to rebound in the stock market, we can see that inflation expectations haven't really taken off. So the markets clearly still worry that perhaps there is some kind of a growth negative thing that's going on here. But at the very least, that the Fed is not going to be hamstrung by surging inflation in its quest to cut rates, and they've clearly seemed to embrace as much. So looking at it in these terms, then we end up with a relatively sanguine state. Exposure wise, I am still looking for the dollar to continue to bottom, still short the Aussie, the pound. I doubled down on the euro short earlier this week, still short the Canadian dollar, looking for the greenback to continue to recover because clearly it's showing some heroic strength here with all this talk of rate cuts and precious metals surging and the environment seemingly saying that all should be going wrong for the dollar, and it very clearly isn't. And so that kind of resilience typically speaks to a tremendous reserve of strength. So I'm happy to be long that. Clearly, this attempt at taking pot shots at the stock market didn't work. So I'll be getting rid of this S&P position when markets open tomorrow. This is exactly why I use SPY to keep things small. It's exactly why I look longer duration to reduce my exposure to underlying delta. It's exactly why I use put verticals to keep my risk contained. Once again, fighting the stock market has not worked out, so that this will be a trade to take off. The bonds still working, so staying in the call vertical there, and still looking for this rebound in crude oil to falter and for the larger downside break from last week to continue, and holding a little bit of a put vertical there. And that is macro money for today. As ever, we are here right after overtime, show that I typically co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things go therefrom. Likewise, writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Tasty Trade's Money Match event. Unlock 30 days commission-free trading, plus a 1% cash match on all qualifying deposits to jumpstart your trading when you open and fund a new Tasty Trade account. Level up your trading experience with Active Trader Mode, smart order tracking, risk analysis tools, dynamic watch lists, and more. The Money Match event starts now, exclusive to new Tasty Trade customers.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Global markets never sleep. Explore them with Forex, now available on Tasty Trade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on Tasty Trade.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
The future of trading is here. Join Mike and his whiteboard, plus the tastylive crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
If you've ever been curious about where to start with crypto, join me, Ryan Grace, for the Tasty Crypto Show. Alongside co-hosts and industry guests, we'll break down what's going on in the market and show you how to take advantage of crypto. No hype, no shills, just crypto know-how. Watch us live, join the chat, and fill your bag each week on the Tasty Crypto Show.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Mike, what does it mean to be assigned?
When you are assigned, you are ultimately short an option that's in the money, and the counterparty has the ability to exercise that option. So if you are assigned, it means your option, against your will, ultimately, has turned into 100. Just the ability to see that green number on your screen and get out in a profitable way.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
All right, we're back. It's the Tasty Crypto Show. I'm Ryan Grace. And with me today, of course, special guest and fan favorite, Greg Magadini, Director of Derivatives over at Amber Data. Greg, how you doing?
Doing well. Thanks, Ryan. Appreciate it. I was out in New York, out in Chicago on a live show not too long ago. So it was fun to be out there with you guys.
Yeah, I missed you while you were in the studio. I wish we could have done the show together here in person, but this works, I suppose. Next time you're in this city, we'll have to do that. But I think it was a great show. And it seems like everything that you've ever said as you've been on this network has played out amazingly, which I love to see.
I appreciate that. I'm on a lucky streak here.
Well, you're pretty good, my friend. All that said, what do you make of everything going on in the market, not just with crypto right now, but we've got to talk about gold just nonstop ripping higher, Bitcoin hitting an all-time high, not quite alt season, in my opinion. But equities at all-time highs, and I mean some massive moves in some of these tech stocks like AMD and Nvidia as well. What are you seeing out there? What do you think is behind some of this? And at the same time, I mean, are we in bubble territory? A lot of people want to try to call the top here. Are we there, or does it continue?
Yeah, that's a great question. So my base case scenario is don't fight this trend. This is a very sharp trend higher. I'm not super interested in getting long tech stocks personally. That's not my main market. I like these hard assets, Bitcoin, gold, silver, and the other big trade that I love to talk about is dollar yen. So dollar yen continues to rally, and we had some interesting developments in the week over the weekend there as well. But I think overall, we have a pretty bullish, intact trend higher in Bitcoin that's essentially in tandem with gold and being reinforced by silver and platinum. And so I think the bets are more upside going into the end of the year. And so finding ways to structure upside exposure in a smart vol way is the interesting play here.
Yeah, we were talking recently about some of the the market seasonality, specifically with Bitcoin, that seems to be in play at times. And right on time to start October, you saw the Bitcoin price take off here. Is there anything to that? I mean, when you look at the data, like clearly the fourth quarter tends to be a period of outperformance, less so in the last 5 years, but the trend is still there. And even, I suppose, in some months where you've had a okay September, it's really amplified to the upside. And a lot of times in the last 5 years, it's played out into that Q1 period too. In your opinion, what's behind some of the outperformance that we've seen historically? We call it Uptober. Others refer to October as it as well. Like, is there anything to that, or is it just coincidence?
So it's funny because I had a friend just text me. He said, "Oh, I set myself a note 2 years ago that we'd be at new all-time highs." This is yesterday on October 7th because of XYZ cycle indicators. And look at us now. We're at new all-time highs. And I was like, "Oh, that's pretty interesting." That's a good forethought. I hope he wrote up a lot of Bitcoin, but in my mind, those are less interesting ways to trade it. I fall more into the coincidence camp just because seasonal patterns and cycle patterns are so well known that it creates trading setups against the crowd, so to speak. If everyone's getting long this cycle, there's incentive to kind of slam longs and liquidate them to the downside and things like that. So those types of seasonal cyclical patterns to me are less interesting and more in the random noise coincidence bucket, I think, personally.
So what do you think then is driving price action here, whether it's Bitcoin or, as you mentioned earlier, new highs in gold, and kind of how are you looking to structure a trade around that?
Yeah, so I think what's going on is a bigger macro picture, and I like to call the theme the debt supercycle. And this is not the end of this debt supercycle ninth inning. It's sort of the beginning of it. And that's why I think standing in front of any of these trains is a bad idea. So gold essentially is up something like 55% year to date. Only a couple years ago did it break 2,000 for the first time. And so this is a very telling sign of the fiat situation that we have. We have global inflation. It's not out of control inflation, but it's there. And so I think people are allocating outside of fixed income U.S. Treasuries into sort of hard money assets like gold. I mentioned Japan earlier on the show here, and we just had a new president elected in Japan, and she is the sort of the Japanese Trump, so to speak, and she has a lot of policies to essentially keep rates low, try to grow their way out of the debt to GDP ratio in Japan. China hawk, there's no real military in Japan. It's all guaranteed by the U.S. and the allies after Second World War. So where does the money come from to do a military buildup? It's going to be printed yen, and then you have the back of the yield curve starting to lift off due to inflationary forces. And I just think that yield curve yield increase is gonna roll down more and more towards the short dated stuff. And at some point, with such a high debt load, if you can't refinance at good interest rates, well, you have no other choice than to have the central bank to continue to buy and potentially extinguish existing debt, which is called debt monetization, which is a terminal event for fiat. And so that's why I think we're seeing a lot of these flows, short yen, long gold, long Bitcoin start to come into play. And I don't think this is the beginning. I don't think this is the end. I think this is the beginning.
Yeah, the world and the markets have kind of collectively woken up to, I mean, something that obviously people have been talking about for some time, but maybe the collective realization that the only way out is to just print more money.
Mm-hmm. Yeah, and what's the off ramp? The off ramp is bearer assets. Gold is a bearer asset, meaning if you own it in your possession, it's essentially yours. And crypto is the perfect bearer asset with perfect portability. So it's the only off ramp that is an asset that isn't equal to someone else's liability.
So do you think like some of the price action that we're seeing here in crypto, or, I always use crypto and Bitcoin interchangeably, but really talking about Bitcoin here, do you think some of what we're seeing is just catch up to that move in gold, which given the flows and the size of the market, relatively speaking, if this is the driver, you see that first? Is this just Bitcoin catching up? And then the second part to my question, like, where do you think we go? I mean, I'm not asking you to pick a price target or anything, but some people are looking at this and thinking, okay, at this point in the cycle, it's going to play out just like all the others, going to get a big God candle. Maybe it's the result of some catalyst. Possibly. I mean, is it that, or do we grind higher? But ultimately, like if you're saying this is the kind of the beginning of how you think this maybe plays out, and it depends on the time frame, I suppose. But where do you think we ultimately get to here? Because one last thing I'll say is, a couple of years ago, if people were talking about $1 million Bitcoin, they kind of got laughed at. You say that today, and it's kind of accepted.
Yeah, definitely. And something you had mentioned on the Tasty Live show maybe a couple months ago, does it really matter what the price is? And I kind of like to keep that in mind. It's really not about the price. It's about, M2 supply, M2 digital supply, how many people are bought into that system, and is that system growing? The price is almost irrelevant. It's just a unit of account. And so from a trading perspective, price pays, but from the functionality perspective, it's really about how many economic users are using crypto as a store of value or potentially a medium of exchange. So I think the price can go a lot higher. Right now, the market cap of gold is slightly above 25 trillion, and Bitcoin is something like 2.5 trillion, so 1 to 10. And the gold trend looks intact, and it looks like it's going to keep going higher. So Bitcoin has some catching up to do in certain terms, but also could potentially outperform if the world starts to adopt Bitcoin as a true store of value or medium of exchange. Gold's been around for thousands of years. Bitcoin's been around for 16 years. So it's a little bit of a harder onboarding sell to the average consumer, but it's just something to keep in mind.
Yeah, I think you get there, though. And at the same time, I mean, when you look at adoption, it's like, okay, who are the new users? And the new users today more so tend to be large financial institutions and arguably maybe under the surface nation states, as you see some sovereigns or some of these flows are reflective of clearly larger pools of capital. Okay, what's the trade then, in your opinion? So we've got all-time highs in gold, all-time highs in Bitcoin. We think it's going to continue. How do you express the view? Because you always bring the trades, my friend.
Yeah, so a couple things here. So I want to talk about this. This is the term structure. This is realized volatility versus the implied volatility of the past. So how did the implied volatility predict the realized volatility? So it's the realized variance risk premium. So we really see the front end of the curve finally pay vol buyers. So all that short dated stuff all the way out to 14 days is a little bit of a reward for vol buyers. So that's interesting. And I don't think this move is over. 30 vol is not that high. Gold vol is about 18. So, gold versus Bitcoin. Bitcoin has done a lot crazier moves than gold has. So 30 vol is not that high, contextually speaking. If we look at, I just want to, before I talk about the skew, if we look at the term structure, we can really see that those end of the year options are really sort of the tipping point in terms of vol pricing. So if you are going to buy some Bitcoin volatility, I think the short-term options are more interesting. The move is happening right now, so gamma is sort of the exposure that you want to the upside. And if you want to structure a trade that is maybe vol neutral or maybe short vol from like a 1x2 perspective, selling those December contracts are sort of the interesting point in terms of volatility pricing. The trade, I think we've talked about this trade before. I just still think it's really relevant, is the risk reversal. So this is essentially a year of risk reversal data for 90-day options, which coincides with end of year options. So we can see that the risk reversal is negative. So that means the 25 delta call is cheaper than the 25 delta put. And if we break that out into the separate wings to sort of kind of decompose what's going on, we can see that the call relationship, so this is going to be the 25 delta call divided by the at the money vol on the blue here on the top side, and then 25 delta put divided by at the money vol in orange here at the bottom. We can see that the put wing is expensive, and then the call wing is cheap versus the past year. So really, this gets interesting in a lot of ways. A, I want long delta exposure. B, if I can get that risk reversal in a cheap fashion, that's very interesting. And then something that you mentioned earlier, if we get some of this nation state buy-in into Bitcoin, this thing will go nuts. I mean, we'll get to the 200 handle pretty quick in terms of spot prices. And without the nation state buying, I think the trend takes us up to 150K, just judging by sort of what's going on right now and the relentless march higher in precious metals. I don't see why Bitcoin doesn't follow that.
Yeah, that was kind of the price that if you just arbitrarily throw something out there, we love big round numbers, but that's kind of the spot where, okay, what's the next natural stop along the road? Seems to be you could probably get to 150. This is interesting to me. So you sell the 25 delta put, you buy the 25 delta call, risk reversal. The puts are rich versus the calls here. If you look at the chart you've got up on the screen, you go back to the April period where we had a lot of volatility and the market actually traded down to about 75,000 or so. So maybe for people it makes sense then that there's a bid into the put options. What do you think is behind the bid in puts here? I mean, is this just everybody thinks, well, it's not going to go higher. We've got to start to hedge the downside. But at the same time, it's not like these puts are cheap either, relatively speaking.
Yeah, so the April is a great comparison. That was peak sort of Liberation Day panic. And the vol profile or the vol surface right now for 90-day options mimics kind of where we were back in April. So I would fade that vol profile. We're not in the same environment as we were in April. In terms of why are things the way they are right now? So I think FalconX did some really interesting analysis using our data. They looked at the open interest and volumes of ETF options, IBIT, ETH-A versus Deribit. And this is the first time that Deribit has been eclipsed. They've been eclipsed by the ETF, spot ETF options, both in open interest and volume terms, notional volume terms.
Wow.
So to me, this is very interesting because it's showing us that a different class of investors are now the main users or the main participants of crypto volatility trading. And I think I've made this point on the show before, but this class of investors, aka institutional investors, typically trade Bitcoin as part of a risk-on portfolio, meaning that they sell covered calls for yield because there is no yield in Bitcoin, and they sometimes buy protective puts. So that's my thesis of why the volatility surface is priced the way that it is, and that's the source of the opportunity. When there's kind of one-way flow and there's demand for liquidity, taking that liquidity, taking the other side of the trade can be really profitable, especially if realized performs in a different fashion. I don't think realized vol for Bitcoin is necessarily going to trade like equity vol or S&P 500 options. I think it's a different beast and it trades more like gold. And so it can gap up in ways that are very volatile.
The fact that you have all of these institutions that are stepping in via ETFs and looking to generate yield by overwriting calls on the position, do you think that dampens upside vol in any ways? And I guess the reason why I'm asking that is because quite often, maybe not every day or quite often, maybe that's not the right term, but at times we've seen that dynamic of almost like the tail wagging the dog in markets. You saw this to an extent during the COVID period when you had just rampant call buying by, largely retail participants, maybe not just retail, but, you saw a lot of reports of that. And so you got these big gamma squeezes on the upside as dealers hedge. Like, do you think the opposite is true here if dealers are all long these calls that these institutions are selling in size against these fairly large ETFs? Like, do you read into that at all? Or is it just something where you get the realized move regardless because we're still early stage and the flows into this thing are really what matter?
So I think that's a great point. The dampening effects of long gamma from dealers, delta hedging, things like that. I think that's very true for the traditional equity space because outstanding options open interest is such a large percentage of the underlying market caps for, say, S&P 500 spider ETFs, things like that. But in crypto, the vol space is still relatively small compared to the underlying spot market in terms of market cap versus notional open interest. And so I think the tail wagging the dog effect is not yet big enough to actually move the spot market. So I think Realize is going to do what Realize is going to do. But there is interesting sort of opportunities being sort of a liquidity provider in a relatively small market of crypto volatility. In the future, I do think crypto vol expands its footprint and we could potentially see some of those effects. But as of right now, I would say Realize is going to do what Realize is going to do.
Okay. So then, in summary, maybe fair to say that relatively speaking, call options are cheap in Bitcoin right now. Is that fair?
Yes.
Okay.
They are cheap, yes. And if we're going to play the trend for this kind of continuation of this sharp move, I would play the short end of the volatility term structure. If this is kind of a longer term play, hoping for sort of nation state buy-in, you could play the longer term, maybe the 90 days and roll those out, or maybe even go further out in the expiration cycles.
Would you ever do anything where you have on a calendar or a diagonal where you're going to be short that volatility with a longer duration or tenor versus, where you're long? And I get that you can size these things differently depending on where you're at, but would you go that approach, or how do you think about trade structure for everybody that's watching?
Yeah, actually, that calendar play is really interesting. So it's going to be a little bit margin intensive here because you'd be short the calendar, so you'd be long sort of that October 31st, maybe the November 28th contract, and short that December 26th contract. So you can get long to gamma and short to vega, and you're selling the expensive vega, and then you're owning sort of a lot of gamma on the front end and hoping for a continuation of this move. That's actually a pretty interesting trade structure. I would say it's a little bit more complicated than sort of your classical trade structures. Even the risk reversal is just kind of simple, and you can delta hedge that thing if you want. But the calendar is an interesting play. It's definitely something I would look at, and if I did put it on, I would sell the D's contract and buy the Oct and maybe the November one.
Are you seeing the same profile here when you look at something like Ethereum via, let's say, ETH-A? Do you see the same kind of spread with the term structure?
Yeah, actually, let's go ahead and pull this up. So anyone who's not familiar with our platform, you can go to pro.amberdata.io. This is our GUI, our website. You can see all the exchanges we support. If I go to the TradFi section, I can go to the various tickers. So ETH-A, we can pull this up right here. And so we can see some of the vol pricing and surfaces. So if I go, let me go ahead and just kind of look at ETH-A in terms of vol and risk reversal skew. So ETH-A is actually kind of interesting. So if I kind of isolate maybe, again, that 90-day delta, you can see here we're actually positively skewed. So the 20 delta call is more expensive than 20 delta put. So that's kind of interesting. It makes a sense, for if the market's expecting us to finally break through all-time highs and kind of continue from 5K to 6,500, something like that. So there's positive spot vol correlation being priced into that market. That's kind of interesting. But the divergence in Bitcoin is surprising for sure. And that divergence in Bitcoin creates a nice opportunity. In terms of the term structure, so we can see here, if I take the forward vol, we can really see 63 and 84 days out, just sort of the most expensive. But ETH has a very flat term structure, for the exception of the very short end, as we kind of consolidate between 4,500 and 5,000. Everything beyond that is pretty flat in terms of volatility. So volatility is 71 going out a couple years. We got 6 months, it's 73, 74-ish. So that's kind of interesting to look at. And if we decompose the different wings for, say, 84 days till expiration, let me go back a little bit here. And so we can kind of just see that the call wing is definitely pricier in ETH than the put wing. And so the vol surface is more bullish and optimistic to upside surprise in ETH than it is in Bitcoin.
In terms of it's cheap, where you just aren't seeing many people kind of, let's say, betting on that happening just yet?
I think it's priced in for ETH to have some upside.
Oh, God, I see what you're saying. Not so much like the trade setup, but like how it's being expressed right now. Obviously, those calls are more expensive versus what we saw with Bitcoin.
Exactly.
Okay, interesting. So the risk reversal seems to be the trade or potential opportunity, I suppose, in Bitcoin. Not so much seeing that in ETH at this point. And then when you look out kind of on the curve here, if I'm reading this correctly, and maybe it's just a function of you haven't had the realized move in ETH that you've had in Bitcoin, where Bitcoin's at an all-time high and ETH's kind of just chopping here around 4,500. You think that's the explanation for why you have a somewhat flat surface there? You just don't have, and maybe also it's just like the product's newer and smaller.
Yes, the product's newer and smaller. That's for sure true. But I think your analysis is right. We are kind of waiting for this moment to happen, and as we approach expiration, the term structure just kind of falls down 10 points, and I imagine once we get that breakout, this thing flips straight into backwardation.
Yeah, just need that realized move for everybody to then get the FOMO and pile in.
Yeah, that's an interesting, maybe short-term setup. If I was day trading the underlying spot market or the futures market, any sort of breakout probably has some good follow-through. And then in terms of sort of the options market, I think once we get that breakout, those short-dated options just pay the price and kind of ride that breakout, I think makes a lot of sense.
Yeah, one of the trades, is I mentioned to you prior to going live here, one of the things that I've been doing more recently, and I'll start to post these on the follow feed and the Tasty Trade platform as well, but I've put on a decent-sized ETH-A position, and I've been selling some calls against it because, as we've discussed here, and not to go to strikes or anything, but as you go out November or December, I mean, you can get quite a ways away from the current spot price and bring in some decent premium, where if you're bullish ETH and you do actually get this move, you're getting paid to sell those calls against it. And as you just showed, you got some premium in those call options as well. So another trade idea for everybody.
Yeah, I love that. And I think, we are still waiting for SEC approval for some of those proof of stake reward distributions from the ETFs. I do think that's an interesting catalyst that could potentially break out prices. And that gets really interesting if you're selling those covered calls, because now you own ETH, you get the staking rewards, and you get some covered call yield. That's a nice yield machine, so to speak.
So, Greg, to that point, I don't know if it was yesterday or a couple days ago, I saw a headline where Grayscale is staking some of the Ethereum and passing on rewards to investors in the ETH trust as well as the mini trust. But I was unclear as to like whether that was an SEC decision or they're just going ahead with something, or if there's a different structure to the product versus say ETH A. Do you know anything more about that, or why they just suddenly decided, hey, we're just going to do this?
Yeah, that's interesting. I haven't looked into that, but I imagine there's probably a few structures. Like in traditional finance, good earnings, sometimes instead of paying out a dividend, they'll buy back shares. So I imagine maybe there's that type of mechanism going on with those proof of stake rewards. Maybe you do another, instead of paying out the straight dividend, you do some other type of function that is economically equivalent. But I do think an actual dividend is a little bit more attractive for those long-term portfolio holders who live off income and need income. And I do think that traditional setup is would be a real catalyst for ETH. But I'd have to check out what you mentioned. I didn't look at that.
Yeah, I didn't really see the details around it, but maybe again, it's like you've mentioned with what some of these treasury companies are doing too, where they're putting the ETH to work, so to speak, and then that's reflected in the value versus it's just a straight pass through. But in a world where you get the staking rewards in the form of a dividend, I mean, I've got to imagine that incites some capital inflow, or at least a little bit more interest from some of these larger institutions to learn a bit more about ETH. And I also think it's just a matter of time too, right? Like we're seeing these massive flows into Bitcoin where before it was 100 million, $500 million. Now it's like you could get a day where you're well over $1 billion in terms of inflows, in a week where you're 5 billion plus in some of these products. I think it's just a matter of time until more institutions, more people just learn a little bit more about ETH. Whereas like the Bitcoin story, it's easier to understand, I suppose. It's digital gold, right? Okay. Break that down, you kind of get it as a traditional investor, like that makes sense. Well, what is ETH? ETH has lacked maybe a value prop for a lot of people that are outside of the space, or like a story. But I think as soon as people have a reason to look into it a little bit more, maybe it's just they become comfortable with the Bitcoin investment. It's gone up, we get that. All right, what else is there? Bitcoin's the gateway, so to speak. I think you're going to see the flows, and maybe you already are, right? Recently, we've seen some sizable money come in there.
Yeah, it's very interesting. Absolutely. And I think ETH, because it falls into the altcoin category, then people start questioning, well, should I buy ETH or should I buy, Solana or something with a smaller market cap, or what about XRP? And that story, like you said, is less clear. Bitcoin is like, it's a clear story. And so I think that is also part of the dynamics going on here.
One last question for you, because everyone always wants to know in terms of timing, like, is there anything that you're looking at for when you might want to rotate, if you do want to rotate into any other trades outside of Bitcoin or maybe outside of ETH? Like, when is alt season? Does Bitcoin have to hit a new price? Does the Fed just have to take interest rates lower here? Do we maybe possibly even need to see, some sort of open market operations or some sort of QE? Like, what would you look at, or kind of is it just price action for determining when we might be in altcoin season?
I think the story narrative has to shift. So we saw a lot of Bitcoin outperformance after the SVB banking crisis in 2023. And that story kind of has held steady. Then you had, the Ukrainian war and all, Russia-Ukrainian war and all that stuff that also kind of supported sort of the big picture story that helps Bitcoin. Now, we do have a massive AI boom and NASDAQ tech stock rally that should help theoretically for crypto Web3, which is crypto tech. But we're not seeing that translate yet. And I think the truth is that this is still debt-related macro flows as opposed to innovative efficiency technology flows. And so that's what I would have to see the narrative shift in my mind.
Awesome. Well, Greg, we'll leave it there. As always, appreciate you coming on the show. It is my pleasure. So thank you for coming on here. Before we let you go, though, where can everybody find you, learn more about Amber Data, and use the tools that we're showing here on the show? Because you've got some really powerful stuff and you're doing some great work over there.
Yeah, absolutely. So if you guys want to check out the website and sign up to use some of these tools and look at these charts, you can go to pro.amberdata.io. And if you want to read the weekly newsletter where we have our analysis on a Sunday release, you can go to amberdataderivative.substack.com.
Awesome. Well, Greg, thanks again. We'll look forward to having you back on the show here in a couple weeks or sooner. But I will be back on Friday with Shelly on Beans over on the Tasty Crypto channel, streaming live. We'll be back on Monday here on Tasty Live for the Tasty Crypto Show, same time, same place. Until then, I'm Ryan. Thanks for watching.